Welcome to today's video where we will delve into the topic of understanding implied volatility. Implied volatility refers to the market's expectation of future price fluctuations. It is a crucial factor in determining option prices as it affects the probability of a stock's price moving significantly. Implied volatility can be interpreted using volatility charts, which display the expected level of price volatility over a specific time period. These charts can help traders predict potential movements in options and adjust their strategies accordingly. Historical volatility, on the other hand, looks at the actual volatility observed in the past. By comparing historical and implied volatility, traders can gain insights into whether options are currently undervalued or overvalued. Implied volatility tends to increase during periods of uncertainty or market turmoil. Conversely, it tends to decrease during periods of stability or when market participants have a high degree of confidence. When implied volatility is high, option prices increase as traders are willing to pay more for the potential upside. On the other hand, when implied volatility is low, option prices decrease as traders are less willing to pay a premium for limited upside potential. Understanding implied volatility is crucial for option traders as it can impact their profit potential. Traders need to consider implied volatility when selecting which options to buy or sell. Volatility charts can help traders identify periods of heightened or decreased market volatility. By analyzing these patterns, traders can better time their options trades and potentially increase their chances of success. Historical volatility can provide context on how a stock has performed in the past and whether it tends to move significantly. However, it's important to note that past performance does not guarantee future results. Using implied volatility and historical volatility together can give traders a more comprehensive view of a stock's potential volatility. Traders should also be aware of the concept of implied volatility rank, IVR. IVR compares the current implied volatility to its range over a specific period, indicating whether it is relatively high or low. By considering IVR, traders can identify options that may be priced more attractively compared to historical levels. In conclusion, understanding implied volatility is essential for option traders to make informed decisions. Volatility charts, historical volatility, and considerations like IVR can provide valuable insights into option pricing and market expectations. By grasping these concepts, traders can enhance their ability to interpret and navigate options markets successfully.